Good morning and welcome to TOI Japan Market Radio for Tuesday, March 24, 2026. I'm your host coming to you from Tokyo, and this is your daily briefing on Japan's equity, currency, and rates markets for global investors tracking Japanese exposure. Joining me today is our portfolio manager who focuses on Japan macro and equities. Let's dive straight into today's session.
Thanks for having me. We saw a solid session for Japanese equities today. The Nikkei 225 closed up 1.43% at 52,252.281, and the TOPIX performed even better with a gain of 2.296%, closing at 3743.0. The Mothers Index added 0.522% to finish at 2311.0, while the J-Right Index was essentially flat, down just 0.077% at 1938.0. On the currency side, the dollar-yen pulled back 0.279% to 158.79. Commodity-wise, gold in yen terms rallied 2.132% to 16,525.0, and crude oil surged 4.176% to 91.81.
That's quite a divergence between the equity strength and the yen weakness we've been tracking. Let's start with the main catalyst behind today's rally in Japanese equities. We're seeing headlines that falling oil prices were a significant driver for the Nikkei's advance. Can you walk us through what's happening there?
Absolutely. The initial narrative driving today's session was a decline in global crude prices, which provided a meaningful tailwind for Japanese equities. Remember, Japan is one of the world's largest net energy importers with virtually no domestic oil production, so movements in crude prices have outsized impacts on the entire economy. When oil prices decline, input costs fall for Japanese manufacturers, transportation companies, utilities, and really across the supply chain. This directly improves corporate profit margins and reduces inflationary pressures domestically.
So this is essentially a cost relief story for Japanese corporates. How are you thinking about the implications for the equity market beyond just today's session?
The near-term effect is clearly positive, as we saw today with the Nikkei up 1.43%. Lower oil prices particularly benefit cyclical sectors like autos, chemicals, and transportation, which are core components of Japanese equity indices. The broader market sentiment improves because investors see better margin outlooks and reduced cost pressures. However, the sustainability of this move really depends on whether oil prices stabilize at these lower levels or if we're just seeing temporary weakness. If crude remains depressed, we could see continued support for Japanese equities, but that's far from certain given the volatility we've seen in energy markets.
And what about the implications for the yen and Japanese government bonds?
On the yen side, lower commodity prices should be modestly supportive over the medium term. When oil prices fall, Japan's import bill declines, which improves the current account balance and reduces one source of structural yen weakness. That said, commodity-driven currency moves are often secondary to broader monetary policy considerations and risk sentiment. For JGB yields, falling energy costs introduce deflationary pressures that could reinforce the Bank of Japan's accommodative stance. If inflation expectations moderate because of lower energy input costs, that keeps long-term yields anchored and reduces pressure on the BOJ to tighten policy aggressively.
That makes sense as a near-term positive catalyst. But we're also tracking conflicting headlines on oil prices themselves. There are reports that crude has actually resumed its advance amid concerns about escalation in the Middle East conflict. How do we square that with the story we just discussed?
You're absolutely right, and this is where the narrative gets more complex. While today's equity session benefited from the perception of easing oil prices, there are concurrent reports that crude is climbing again due to renewed geopolitical risk in the Middle East. Market participants are pricing in elevated risk that the conflict could escalate further, which is driving oil higher. For Japan, a sustained rise in crude prices is a headwind, not a tailwind. Higher energy costs increase the trade deficit, push corporate input costs higher, and complicate the BOJ's inflation management.
So we could be looking at a reversal of today's positive momentum if oil prices continue climbing. What would that mean specifically for Japanese assets?
Exactly. If oil prices remain elevated or continue rising, the impact on Japanese markets becomes mixed to negative. For equities, energy importers and consumer discretionary firms face margin pressure as costs rise. Exporters might see some offset from a weaker yen, but that gain is often negated by higher input costs. On the currency side, rising oil prices typically weaken the yen because Japan's import bill increases and investors reduce carried trade hedges, shifting to commodity currency proxies. For JGB yields, sustained oil strength introduces upward pressure if inflation concerns intensify. Investors start questioning the BOJ's credibility on price stability, and real yields could rise as a result.
So the oil price dynamic is really a two-sided risk for Japan right now. On one hand, falling prices support equities and give the BOJ room to stay patient. On the other hand, rising prices due to Middle East tensions create inflation headwinds and currency weakness. How should global investors be thinking about this tension?
It's critical to monitor both the direction of crude prices and the underlying drivers. If oil is falling due to weak global demand, that's actually a double-edged sword because it signals slower growth, which isn't great for Japanese exporters. But if oil is falling due to oversupply or geopolitical de-escalation, that's a cleaner positive for Japan. Conversely, if oil rallies on supply disruptions or Middle East escalation, Japan faces a clear headwind through higher import costs and inflation volatility. The key for global investors is to watch both the crude price level and the narrative driving it, because the implications for Japanese equities, the yen, and JGBs are quite different depending on the cause.
Shifting back to equities, we mentioned the Nikkei was up 1.43% today and the TOPIX outperformed with a 2.296% gain. That's a notable spread. What's driving the TOPIX to outperform the Nikkei on a day like this?
The TOPIX is a broader, more value-weighted index compared to the Nikkei, which is price-weighted and concentrated in a smaller number of large-cap names. When you see the TOPIX outperforming like it did today, it often signals that the rally is broad-based across sectors and market caps, rather than driven by just a handful of mega-cap stocks. Today's move suggests that the market is pricing in the oil cost relief story across a wide range of Japanese corporates, not just the Nikkei heavyweights. That's generally a healthier signal for the sustainability of the rally.
And we saw the Mothers Index, which tracks smaller growth companies, up a more modest 0.522%. Does that tell us anything about risk appetite?
It does. The Mothers Index represents smaller, often more speculative growth names. When it underperforms the broader indices like we saw today, it suggests investors are favoring quality and cyclical value over high growth, high risk plays. That's consistent with a rally driven by cost relief and margin improvement rather than pure risk on euphoria. It's a more defensive, fundamentally driven move.
Meanwhile, the J-Right index was essentially flat, down just 0.077%. What's your read on that in the context of today's broader market strength?
J-Rights are sensitive to interest rate expectations and economic growth outlook. The flat performance today suggests that investors aren't pricing in a significant near-term shift in either BOJ policy or domestic economic conditions. If the market believed lower oil prices would lead to sustained disinflation and even easier policy, you'd expect J-Rights to rally on lower discount rates. The fact that they didn't move much tells me the market is cautious about declaring victory on inflation or assuming the BOJ will ease further.
That's a good segue into the currency market. We saw dollar-yen pull back 0.279% to 158.79 today. That's still an elevated level historically. How are you interpreting that move in the context of everything else we've discussed?
The pullback in dollar-yen is modest but consistent with the lower oil price narrative improving Japan's terms of trade. At 158.79, we're still near multi-year highs for the dollar against the yen, which reflects the persistent interest rate differential between the US and Japan. The 0.279% move today isn't enough to signal a trend reversal, but it does suggest that some of the extreme bearish yen positioning may be getting scaled back as commodity headwinds ease. That said, any sustained yen strength would require either a meaningful shift in BOJ policy or a significant de-escalation in global risk that drives safe haven flows back to Japan.
And on the rate side, how are JGB yields responding to today's developments?
We don't have precise JGB yield data in today's snapshot, but based on the broader narrative, I would expect modest downward pressure on yields. Lower energy inflation reduces medium-term price pressures, which keeps the BOJ patient on further rate hikes. If the market believes the BOJ has room to stay accommodative longer, 10-year JGB yields should compress modestly. However, if oil prices reverse higher as we discussed, that deflationary impulse disappears and yields could drift higher on inflation concerns.
So really, the oil price trajectory is the key variable for Japanese markets in the near term. Looking at today's session in totality, what's the main takeaway for global investors with Japan exposure?